Okay, thank you for the kind introduction, and it is my great honor to have a chance to share my research. And it's about fintech. It's essentially a survey paper, although I try to assess some of the welfare implications of this very important global trend. As a background, I started teaching one course called as FinTech and Financial Regulation from 2018. So I have been teaching that course 4 times. And then while teaching that course, I thought it would be useful to organize the literature, fairly recent literature in this area. So that's why I wrote a survey paper, and my presentation today is some key points from that paper. So with that, let's go into the okay. Whenever I present something, it is quite often the case that I cannot cover until the last page. So this is the research objective and some of the key findings. So the research objective is to assess the industrial and welfare implications of the fintech. I will tell you more about what we mean by fintech, which is not a concretely defined concept. It is evolving, and it also has quite diverse implications in different countries and different geographical areas. Some of the key findings I want to note at the outset is that thanks to various segments of this industry, the efficiency of financial intermediation has greatly improved. It also has a fairly deep impact in expanding financial inclusion, both in developing countries as well as developed countries. Another, what I think is a quite important outcome out of this ongoing trend is the narrowing so-called credit gap. This is an issue about information asymmetry, which is a long and quite popular topic in finance. And fintech intermediaries, they use so-called soft data, so-called alternative data in ex-ante credit evaluation. So I will elaborate more about that point. But this trend has also a cost. There has been documentation about the tendency of over-leverage, both in the US as well as in Korea. So they are sort of documented empirically based on real data. So that's one area that the policymakers should give some attention. Also, this may be a particular issue in the US, but there has been a discussion about whether or not fintech lenders, particularly P2P lenders and crowdfunding platforms, they are up to the challenge for the function designated to them, more and more so. There is a credit evaluation capability. There is a delegated credit assessment to the P2P lenders in the US. So there has been a discussion about whether or not they are actually capable of doing that in a proper fashion, or they have an advantage over other market participants in performing that role. Last point I want to emphasize is about so-called big techs. the Amazon, Google, or Alibaba. In Korea, the Kakao Group is emerging big tech corporation. These large IT companies, traditionally, they are not financial service firms, but they are expanding to various segments of financial service industry in a quite rapid fashion. And it has its own peculiar aspects. So the policymakers should deal with big tech in a separate fashion over other market participants in this space. That is startups and SMEs. They have a different policy implication. So with that, the presentation, there is I don't think you have this PPT file, but I included the abstract. And let me know if you need the copy of my presentation file. I will be happy to share that. Now, this is the outline. I will go over some of the what I believe as key trends in the fintech industry. Theoretical underpinning, I want to spend some time as to what financial theories have been saying about this phenomena. Then empirical evidences and welfare and regulatory implications. So I will try to wrap up within 25 minutes or so. Trends. The first issue is about definition. How do we define fintech? I don't think there is a agreed upon definition for this one, and I listed some of the alternative definition shown in the literature. As you can see in the red font, some people define fintech as an application of technology or a new financial industry or a economic industry composed of companies that use technology. Some people even define fintech as academic discipline, a cross-disciplinary subject, and so on. So in this study, what I used as a working definition of fintech is those financial services enabled by the innovative technologies and digital data. The digital data part, I personally view as a very important ingredient in fintech services. Those services that potentially supplement or replace human-based services in the financial service sector. So it's a little long, but that's a working definition I carried in my research. Specifically for particular types of fintech service, I tried to document the findings from the literature. The first one is online capital raising services. So it's a platform-based, digital data-based, online, meaning that either internet or mobile platform-based the services. So the examples include various different types of P2P lending and crowdfunding. The second part is alternative payment services, particularly based on mobile and smartphone based services. The third one is the online financial advisory services, what we call as a robo-advisor. This is another rapidly expanding types of alternative financial service. The last one is what we call as a RegTech, regulatory compliance. So I included this last one just to demonstrate that this increasing application of platform and digital data in financial services goes beyond the consumer-driven financial services, but it expands to the back office functions of risk management, as well as automation in the internal control systems. Then this picture shows some, telling storylines about the development of fintech industry. As I emphasized, these technology and digital data play an important role. And as we know, the wireless communication technology, what we call as 3G, 4G, 5G, its origin was actually 1980s. We had a 1G in mid-1980s. At that time, I remember that I saw someone carrying a brick-type, very big mobile phone. But then now, these days, we have 5G. But one thing that I want to show you from this picture is the importance of mobile phone or smartphone, which was introduced around 2007. And I think the fintech trend has different paths between the US and some of the Western European countries and the rest of the world. In the US and Europe, in 1990s, I worked in the US, and at that time, the internet strategy was a keyword. The WWW, what we call as a World Wide Web, that was invented in 1989 by one of the British engineers. And then in 1990s, the internet-based business was growing very rapidly, like the companies like Amazon, Google, Apple came later, but all those IT companies have been growing very rapidly, but their growth path was accelerated quite a lot, as you see in the graph, which shows, it's quite difficult to see, the Google, Amazon, and Apple, their growth path was much more accelerated after the introduction of smartphone. So I personally believe that in the US and some of the developed countries, the fintech phenomena may be a continuation of the technological progress from 1990s. So combining effect of internet and smartphone, that's what we see as a underlying force for fintech. Whereas for the countries like Korea, the dotted line there, is there a light function here? No? Okay. The dotted line in the graph is the text analysis done in Korea among popular press articles. It essentially counts the frequency of word fintech in Korean. We call it fintech. So that the very rapidly increased from 2014. So that's the time when the Korea had the first mobile payment system, Kakao Pay, that was introduced around 2014. Then, there are other types of fintech, P2P lending and others were also introduced around that time. And then if we see the Chinese P2P lending platforms, Chinese P2P lending platform, it's about the same time. There were earlier Chinese companies than 2014, but many leading Chinese P2P platform emerged around that time, around 2014. Whereas in the US and UK, the leading P2P companies like Lending Club and Zopa. Zopa is the British company. Their name stands for Zone of Possible Agreement. So the P2P lending platform's function is essentially to find the lending rate that borrower and investor can agree upon. So those leading P2P lenders in the US and UK, they started their business around 2007, so much earlier than those fintech companies in Korea and other countries. Okay, I will speed up a little bit, and the growth in terms of some of the fintech segments are quite staggering. I don't want to go through all the numbers here, but as just one example, size of the P2P lending and crowdfunding globally, it was about 11 billion in 2013, but after several years, in 2018, it became over 300 billion. So within several years, there was explosive growth, and there were similar growth in volume, as well as underlying R&D. You know, the one example, my favorite example, is the number of AI-related patents published by Chinese companies, particularly for the deep learning area. The number of new patents in 2013 from Chinese company in this area was only 3. But in 2017, the total number of patent publications in this area grew to 652. So a huge increase in the underlying R&D as well. This graph shows the regional growth pattern in online capital raising activity. If you see the 2018, the most recent year, by the way, these data are from Cambridge University. They have a very useful research center on fintech, the Cambridge Center for Alternative Finance. And according to their data, in 2008, the Chinese P2P and crowdfunding volume dropped by 40%. So 40% drop within 1 year, whereas in all other areas, there were very strong growth in this space. In fact, in China, from 2014, more than 3,000 P2P lending platforms were either closed or in operation. You know, there has been a lot of consumer issue because of that large-scale failures in P2P lenders in that country. So which implies that this new area can have a significant implication in terms of financial market stability. So that's one thing that I want to emphasize. I will skip all this. They are substituting various existing financial services by the branch-based banking, which is rather obvious. The payment system, mobile payment system, as well as cryptocurrency, they are the important alternative payment systems. And mobile payment system is expanding its role. both in developing and developed countries. Cryptocurrency, which is expanding its use as well. But as you can see in this graph, its price has been very volatile in recent years. So as an alternative money, there has been a concern and question raised about its role as an alternative to fiat money. But underlying technology, the blockchain and DLT, their application is being expanded. Okay, so skip all this. Automating back office function and risk management function. I'll skip this. Theories, in my paper I discussed the excess yield, the concept of excess yield as an indicator of efficiency in financial intermediation. And I don't want to go through the details, but this risk premium is one of the items that should be properly reflected. But the problem is this measure is forward-looking. So you have to apply some of the forward-looking measurement method. So unless you have a historical data, that task is usually quite challenging to perform. But as I mentioned earlier, some of the P2P lenders in the US, they have been getting more and more delegated function for assessing credit risk for their loan applicants. And they have demonstrated that they can play that role quite properly in some part of risk management, segmenting the financial consumers based on credit risk level. And then there are some empirical evidence, increasing volume of empirical evidence for that. But in my study, I discussed the likelihood that they did not prove that they have capability, full capability of risk-based pricing or marginal cost-based pricing. That's one area that I think we need more research. In the US, the Philippon, who is teaching at NYU, he has a paper in AER, American Economic Review, demonstrating that US financial industry has been too expensive. They have been making too much money that cannot be justified based on the long-term equilibrium level profit. And then they propose FinTech as an alternative banking model. I will revisit this. Then I discussed about information asymmetry. For the developing countries, this financial inclusion and FinTech, there has been more and more studies about the increasing financial inclusion in developing countries. Maybe I will go right to that. For example, in African countries, there has been various the mobile payment systems. Yeah. Mobile payment systems. And some of you may be familiar to some of these service providers. So it is expanding quite widely, although there may be some people who have not been served with this new technology. But one interesting aspect of the mobile payment service in Africa is so-called agents. They have each mobile payment system in Africa. They have a fairly large number of so-called agents. They are basically human ATMs. They provide a service to make the payment service complete. Some part of transaction is not completely electronic, but it's a human-based service. So that shows that there is a room for further efficiency gain in this particular service in that area. Then as I have only a couple minutes, why don't I go right into the implication. Okay. This technology and data-driven alternative financial service, I think it has a fairly big welfare as well as industrial implication, because it may be a paradigm change in the traditional financial service. After the global financial crisis, there has been a lot of discussion about so-called narrow banking. Narrow banking means that a long time ago, finance was a very simple function. They get the deposits, and then they use that deposit to have a essentially no-risk lending, short-term and very low-risk lending in terms of interest rate risk as well as credit risk. But then during the last 50, 60 years, there has been various maturity and risk transformation facilities, like asset securitization, derivatives market. So the finance became more complicated, but more refined in various aspects. And that can also increase financial inclusion in some countries. But we all know one of the outcomes of this long-term development was a big financial crisis, global financial crisis. Then this DNA-driven, fintech-driven financial service essentially makes one-stop shopping for financial service rather than the branch-based financial service. So fintech, if you use a mobile phone or internet, you can use the financial service pretty much as real time for various online and offline transactions. And it can be financial transactions as well as non-financial transactions. So that became possible. Then there are various regulatory and industrial issues because of that. How to regulate the fintech industry, or how to make a leveled playing field between fintech industry and existing financial service industry, or how to differentiate big tech companies versus startups. There are a lot of open regulatory issues, but to me, this is a very different form of financial intermediation. So we are still in the transition period, but within next 5-10 years, we may be facing a quite different form of financial service sector in a number of countries. Others, I'm sure my time is up. Okay, 1 minute left, okay. The other implications I discussed is the risk-based segmentation. In the finance literature, Because of information asymmetry, there has been an excess demand in the credit market. In the insurance market, that's more like pooled equilibrium versus separate equilibrium based on the risk level. So fintech industry shows a sign that they can improve the credit risk assessment by using soft data. But I don't think they have demonstrated that they have the advantage over other market participants in implementing the actual really fair, the risk premium for their service. So it's a long story, but I will just skip that. Welfare implications with the fintech versus existing financial institutions. So why don't I stop here? And sorry for rushing my presentation. If you want to see more details from my study, please let me know. I will follow up later on. Thank you very much for your attention.